Let me also now go across to our very special guest this morning, Ridham Desai of Morgan Stanley, also joining us on the phone line. Ridham, great to have you on a morning when we're tracking the reaction post the FM's big announcements late on Friday. First up, I just want to get your view on how much of a booster shot you feel some of these measures will be for the markets. Reaction this morning still a little tapered, probably because of the global dynamic. But how do you feel this will impact the domestic economy?
Hey, thank you for having me on ET Now. So I think the most important takeaway is that the government has not used the fiscal lever. And I think the fiscal space is limited. But more importantly, what we are trying to do from a policy perspective is to rekindle growth by lowering interest rates. And had the government gone for a fiscal stimulus, which several quarters of the markets were pressing for, it would have clipped the wings of the RBI, and we would not have been able to lower interest rates further. Additionally, in an environment where central banks around the world are cutting rates, this would have not worked well. And in fact, using fiscal stimulus may have actually caused growth to slow down eventually, say in a quarter or two from now. So not using the fiscal space, I think, is the biggest takeaway from Friday's announcements. Obviously, I think the PSU bank recap was a very important step, and I hope this is done ASAP. It was something that we had put on top of our agenda, that if the government has to do one single thing, it would be to recap the PSU banks. I think it creates a potential for fresh loan growth, and that is, I think, adequate enough to stimulate the economy. So from a domestic perspective, I think what the government is doing is right, and I think it should help lift economic growth. Remember, in the last quarter, which is the quarter ended June, central government spending grew at just 2%. The central government spending is about 8% of GDP. If that normalizes in this quarter, as the government is suggesting, when the government makes payments, it's basically spending money. That itself would lift the GDP growth, say, QOQ by 100 basis points. So I think this is par for the course. The actions are, I think, reasonable. Now, you made the point about the global economy. I think that continues to act as an overhang. And the fact is, India has 20% of its GDP coming from exports. And we are increasingly of the view that the risk of a global recession is rising. In fact, over the weekend, we have cut our global GDP growth even further after having done one cut last week. So essentially, I think this big overhang remains, and that, I think, caps the absolute upside on share prices. But the measures the government has taken, I think, is good enough to close out India's relative underperformance to EM, which has been quite stark over the past 4 or 5 weeks.
Elements to this. One is, of course, kickstarting sentiment, consumption, getting the engine running again. The other aspect, of course, is bringing the FI money back in and actually seeing an improvement in flows, which have been disastrous, so to speak, since the budget that was announced earlier. Do you feel that we will see that momentum change, particularly given the global dynamic right now?
No, so there are two things to this. Okay, the first is that the outflows that India experienced over the past, say, 2 or 3 months was actually less than what emerging markets as a whole has seen. So there was nothing idiosyncratic about it. There was nothing India-related about it. Essentially, EM has seen big outflows, and India, took part in that. The second thing is actually one of the disappointments that we had on Friday was the lack of any clarification on the finance minister's budget speech. So just as a reminder, in her budget speech, she said that FPI limit will now be equal to the FDI limit. To us, that was a very important announcement to boost passive flows into India, as she had highlighted in the budget speech. Now, we continue to wait for clarification from government, either via press note or any other mechanism to guide MSCI that this is now effective. I think it is a very important thing. From a flow perspective, if this is done as soon as possible, it will lift India's overall weight in the EM index. And together with that, India will witness a surge in passive flows and, in fact, even active flows. But overall, the EM flow environment looks tepid. It is bearing the brunt of a global slowdown. And, part of those outflows that India is witnessing is relating to those.
Rhythm, but can this really revive lending back into the system? Because we all know that the problem was not absence of liquidity, but it was a confidence crisis wherein banks were not willing to lend.
No, I think that is obviously a very fair observation. And to the extent that the government starts spending money, I think it does help a lot because the payments that are stuck in the system get released, and that does soften the blow on especially medium and small enterprises. So I think that announcement, along with the PSU Bank recap announcement, is important. Further, I think the banks have told the finance minister that they will lower the reference rates, so interest rates go down. And then I think if the PSU banks reach out and make the loans, I think you will see a recovery in loan growth. So my view is all this may take a little while, but eventually I think we should see that 5 trillion rupee loan growth number that the finance minister alluded to. And that was, also our thesis when we were dealing with what policy announcements should be made. I think this is the most potent way to revive growth.
Investment perspective, Rhythm, now that the liquidity tap has been opened for PSBs, do you think the pool of investment can go beyond the corporate banks and the obvious names?
So we are constructive on select public sector banks, especially the ones that are well capitalized. We continue to remain positive on the private sector banks. I think they are witnessing an improvement in loan growth. See, remember one thing, if you get loan growth, you also get deposit growth. And therefore, it actually lifts the overall system, which has, something that has been anemic for the past several quarters, which is both loan growth and deposit growth has been anemic. So both of them get triggered. So there is some concern about compressing net interest margins if interest rates are marked down. But if loan growth is recovering, then I think that offsets any margin pressure that banks witness. And the valuations actually are quite attractive, even in the private space. These are not valuations from where you actually end up losing money. In fact, you go back in time, these are valuations from where you end up making money almost on most occasions. So I would think that financials is still the best place to be. One needs to continue to be selective with respect to non-banking finance companies. It will take a while for their growth to come back. They need more liquidity and capital on their balance sheets, and to that extent, their growth may lag system growth. So you have to be very selective there. But I think the large banks, I think, should do quite well in this environment.
Ridham, I have to go back to this entire FPI issue. When the FPI tax came out, FIs, they started complaining, yelling, some started screaming, others started selling. Now that tax has come back, I don't think flows will come back.
No, I don't think, Nikunj, the outflows had to do anything with the tax issue. The tax issue was slightly of a different it was a different problem. The problem was that while on one hand we are trying to incentivize more foreign investments into the country, on the other hand, we end up putting a tax which almost everybody in the government acknowledged post-budget was not intended. So I don't think the tax issue was causing any outflows. The outflows, as I mentioned, was to do with the overall EM situation, and that persists actually. So resolving the tax issue per se does not bring back flows, but it does highlight one very important thing, Nikunj, very important thing, that the government is listening. Because if you see the narrative in the marketplace over the past 2 months, it's been that we're dealing with a government that's not listening to our problems. And I think the Prime Minister on the Independence Day speech, as well as the Finance Minister, has made this very clear that they are not agnostic to the concerns that are there in the economy, and they're working towards fixing them. So to my mind, that is what this reversal on the tax position does. Is that it's a government that's listening and taking on board sensible suggestions. Mind you, a lot of people have also gone and suggested to the government that they should apply fiscal stimulus, and the government has very categorically said that that's not what they think they should be doing. Instead, they will do a lot of other things. So I think it's good to, I think for the market, I think the fact that the government is listening is the biggest takeaway, rather than the tax being reversed.
Ridham, what is the right way of looking at Indian stocks now? Oversold, selling overdone, or before you start buying, think again, the world is in a slightly tricky situation, and these oversold levels or the levels at which mid and small cap stocks have come to, they may remain there. So the price correction could get over, but the time correction is here to stay. What are your thoughts there?
So, Nikunj, I think valuations and sentiment is at levels where historically you have ended up making money if you've been patient. So I said this 2 weeks ago also, and nothing much has changed with that regard. If you go back, we have had about, we had one situation in December 16, then we had one situation in August 13, and then in December 2011, and then all the way back in the financial crisis in December 2008. So essentially, this is the fifth time in the last 11 years that we've had a combination of our sentiment and valuation indicators hitting this level. Now, if you go back, each of those occasions in hindsight proved to be great moments to buy. On some occasions, we had a V-shaped recovery, like in 2013. In other occasions, we did not get a V-shaped recovery, and it tended to be a little bit more muted. I think right now, given the global backdrop, I think we're in that latter position, which is, in hindsight, this may prove to be a great moment to have bought stocks, but it doesn't mean that stocks are going to go up in a hurry or going to put a V-shaped recovery. So there is time which people have on their side, but I think these are levels at which you want to engage in stocks and buy them. Stocks look far more attractive than government bonds right now, and especially down the cap curve, they look extremely attractive. So for people who are patient with their money, I think in 12 to 18 months, they will look back and say, wow, that was a good moment to buy stocks.
All right, Ridham, appreciate your time. You accommodated this interview request at the last minute, so really thank you for that.